Howdy, y'all. Welcome to Liberty 14th, 2023. It's a Tuesday. Hope everybody's having a fantastical day out there. It's a beautiful day here in Colorado. It's a balmy 50 degrees. Woo! I'm wearing shorts and a t-shirt today. So, plus I'm doing a bunch of chores in between, paying attention to what's going on in the markets and doing mostly tax crap and stuff that I got to get done. Anyways, like I said, hope everybody's having a good day out there. The NCAA tournament starts tonight with the play-in games. I know they call it the first round, but it's really the play-in games. I mean, if there's two 15s or two 16s, you're really not in the tournament yet. So, plus baseball season is getting underway, and World Baseball Classic. I watched, U.S. crushed I forget who they were playing last night. Gosh, who was it? They just smoked whoever they were. They were up like 12-1 in the third. I think they were up 9 runs in the first inning. So good games. So if you like baseball, the World Baseball Classic, plus they don't have the pitch clock, which I am not a big fan of in the new games or in the MLB. But hey, Rob Manfred didn't ask me what my thoughts were on it. I personally don't mind games that drag on. That's what I like about baseball, is that there's no clock. Especially if I'm paying to go to a game, I want to, take as long as it can. So, and plus I watch, 2 or 3 games outside of the Astros games that are on, almost every day of the week for 6 months of the year. So, over 6 months, that's probably 160 games. I probably watched 3. I probably watch about 500 baseball games over the course of a season. So anyways, if it's your first time watching, please give me some big old likes, shares, thumbs up, subscribes, follows, all that good crap. I would greatly appreciate it. Definitely a much more calm day in the market. Things, a lot more greens I'm seeing here on the screen, except the overnights in Asia. But everything else looks like, certainly didn't bounce back to where things were yesterday or the day before, but, certainly not terrible. So let's go ahead and jump into the numbers. The Dow Jones was up 1.06%, 336 points, closed at 32,155. S&P 500 up 1.68, closed at 3920. NASDAQ up 2.14%, closed at 11,428. The VIX fell 10.52%. It's currently at 2373. Canada was up 0.54. Brazil down 0.18. Mexico down 0.55%. Heading over to Europe, Germany was up 1.03 or 1.83. UK up 1.17. France up 1.86. Netherlands up 1.41. Spain up 2.23. Italy up 2.36. Switzerland up 0.8. And Portugal up 1.4%. Russian exchanges both green. MOEX up 0.92, RTSI up 0.41. And the overnights in Asia, the Nikkei in Japan was down 2.19, Australia down 1.41, New Zealand down 0.77. The Shanghai in China was down 0.72, the SCSE component down 0.77, China A50 down 0.64, DJ Shanghai down 0.63, Hang Seng down 2.27, and the Taiwan weighted came in down 1.29%. So it looks like the contagion from yesterday trickled over into the overnights in Asia. But, I imagine their markets will probably smooth out today, seeing that the Fed came riding to the rescue. And they're going to make everybody whole with their deposits at SVB Bank. I'm not sure what's going on at Signature. I haven't read the specific details on that, but yeah, it's a mess out there with, with these, that's the problem with fractional reserve banking. And something I meant to bring up in yesterday's video was, if you haven't read The Creature from Jekyll Island by G. Edward Griffin, it's a really good book. It really details, from the creation of the Fed in 1913 or before that, with the banking powers that went to Jekyll Island down in Georgia. And, plotted their, basically a conspiracy. All these retards on the interwebs like to call, Trumpsters and conservative conspiracy theorists, or people like myself who didn't buy into the whole COVID narrative. This was a conspiracy. It changed the way banking was done, allowed for devaluation of the currency, which then, 20 years later, FDR took the gold from everybody. And then in 72 2022, I think, Nixon closed the gold window to foreign governments. And then since then, we've been off the gold exchange standard. So I was doing a little searching around yesterday. I was kind of curious to see what the price of an ounce of gold versus the price of an average house. And, it's stayed fairly stable over the years. I mean, I think the average going back to the 60s was 218 ounces for the average house. It did peak, I think, around 2001 at about 400 and something ounces of gold per house. And then, I think in the early 80s, and then again in, I think 2020, it had peaked at the other direction where it was as low as about 80 ounces of gold. So anyways, just to say that, the inflation we're experiencing is a dollar, is dollar devaluation. It's not necessarily that things are more expensive in relation to everything else. Taking something like gold and silver and comparing it to other tangible assets like homes, cars, things like that, you can really see where the where the inflation is truly at. It's not necessarily in the actual products. All right, well, let's go ahead and dive into today's market recap. Wall Street ends green as inflation cools and bank jitters ebb. Get my notes here. On Tuesday, U.S. stocks made a comeback after several sessions of risk-off turmoil driven by the implosion of Silicon Valley Bank and Signature Bank and worries over contagion. All three major U.S. stock indexes closed in positive territory, with financial stocks clawing back some losses after the S&P 500 Banks Index experienced its steepest one-day sell-off since June of 2020. Investors worried over bank contagion were all allayed as assurances were given by U.S. President Joe Biden and other global policymakers who vowed that the crisis would be contained. Yeah, between President Idiot and that little owl Yellen, who's the Treasury Secretary. They came, like I said, right into the rescue over the weekend, late Sunday and yesterday, saying, "Hey, everything's fine. We're going to bail you out." Frankly, most of these people who are getting bailed out aren't the mom and pops that might have some cash in that bank. These are big, tech companies out in Silicon Valley, which a lot of them are woke, and I really couldn't care less about them. So I say let them starve, because all you're going to do is create more inflation because you're going to have to print money to make these people whole on their investments or on their cash, and all that's going to do is exacerbate the problem. So, anyways, I think I shared my thoughts enough on that. The Labor Department CPI report showed consumer prices cooled in February, largely in line with market expectations, with headline and core measures notching welcome annual declines. Even so, inflation was still still has a considerable way to go before approaching the central bank's average annual 2% target. Signs of economic softness combined with the regional banking scare have increased the odds that the Federal Reserve will implement a modest 25 basis point hike at its key interest rate at the conclusion of its two-day policy meeting on March 22nd. Investors are seeing a coordinated effort with the various government agencies and are feeling as if things have contain themselves a bit. Quote, "If the Fed isn't careful, they could create some unintended shocks to the system," end quote, said Matthew Ketor, managing partner in the Ketor Group, a wealth management firm in Lenox, Massachusetts. Here, Matthew, if you've been paying attention, I know you're a managing partner at a big fancy firm, but the Fed created this problem, dumbass. And, now saying, well, the Fed needs to be careful. Well, they should have been careful 3 years ago and not printed up $5 trillion, because just about every one of my clients is feeling it, having to tighten their belts, across the board, especially the older ones who, they didn't plan for this. They didn't plan for, everything to go up by 40% over the course of a, couple of years. So, you know what? He's worried that they're going to make a mistake now. I mean, come on, please. Part of the stabilization on Tuesday is due to the expectation that the Fed might back off from some hawkish expectations that followed Chairman Powell's comments last week. Meta Platforms announced another 10,000 job cuts in its second round of layoffs, which sent its stock higher. Okay. Well, I guess because they're going to save money. Ride-hailing apps, app rival Uber Technologies, Inc. and Lyft, Inc. also jumped following a California state court decision that revived a ballot measure allowing the companies to treat drivers as independent contractors rather than employees. However, United Airlines Holdings, Inc. fell after the commercial carrier unexpectedly forecast a current quarter loss. Meanwhile, AMC Entertainment Holdings plummeted between multiple trading halts in the wake of its shareholders voting in favor of converting preferred stock into common shares. Overall, the largely on-target inflation data and the easing jitters over the contagion in the banking sector helped cool expectations regarding the size of the rate hike at the next Fed meeting. Investors are optimistic that the coordinated efforts of government agencies and policymakers will contain the crisis and ensure the safety of the U.S. banking system. Nevertheless, investors remain cautious about the economic outlook and the potential risks posed by inflation and future rate hikes. Again, I was thinking of something there as I was reading through my notes. Let me see what I was going to say. Coordinate effort to contain the crisis of the banking system. Yeah, I don't know. Things pop in my head and then they disappear. So, anyways, all right. Well, so that's what's going on Wall Street today. All right. Next article: U.S. CPI falls to 6% in February as expected, but core prices are still strong. Let's dive a little deeper into the CPI report. The Bureau of Labor Statistics reported that the U.S. Consumer Price Index, CPI, rose by 4.4% in February, a slight slowdown from the previous month's 0.5% increase. The annual rate of inflation also fell from 6.4 to 6%, though it remains significantly higher than the Federal Reserve's 2% target. Despite the headline rate showing some moderation, core prices continue to rise at an uncomfortably fast pace, with the cost of shelter accounting for over 70% of the total rise in prices. Food also continues to be a headache for consumers and the central bank, with the price of food at home up 10.2% from a year earlier and the cost of eating out up 8.4%. The annual core rate slowed less than the headline rate, falling to 5.5% from 5.6% in February, and the cost of shelter rose by another 0.8%. The inflation rate was flattered by a fall in energy prices and by ongoing deflation in the used car market. Stripped of volatile components, core prices rose at 0.5%, an acceleration from 0.4% in January, which suggests that the core price index is only moving sideways instead of coming down as the Fed would like. Despite the high inflation rate, financial markets reacted positively to the news, which failed to generate anything like the shock that January's overshoot had done. The S&P 500 futures were up 0.8%, while the Dow futures were up 196 points or 0.6%. The dollar index trimmed its early gains to hit an intraday low of 103.09 before bouncing a little to trade at 103.23, up 0.1% on the day. The report gives the central bank a little extra leeway in its battle to tame inflation, and investors appeared to take the print as mild enough to remove any desire for a 50 basis point rate hike at its policy meeting next week. Goldman Sachs said analysts expect the Fed to leave rates unchanged at the coming meeting rather than aggravate concerns about financial stability. Despite the positive market reaction, the U.S. inflation rate remains significantly above the Fed's target. Yeah, blah, blah, blah. Yeah, it's a mess. I mean, my big fear is that, and I probably said this a lot over the last year plus, is that the Fed is looking for any excuse to help out their buddies in Wall Street and Silicon Valley by keeping rates at or near zero, because then they can borrow money at basically free and invest that money out into the marketplace, which then just grows the economy even more. But my fear is that the Fed is, again, going to take this excuse to then, throw everything in reverse, start lowering rates again, doing more QE, buying up toxic assets, which is just going to exacerbate the problem that we have from doing the same thing 3 years ago and the same thing back in 2009. I mean, these things create inflation, sometimes like in the 2009 TARP and all that, stimulus. It took years for that to really start to rear its ugly head. And, it took much less time when you increase the money supply by such a dramatic amount 3 years ago or 2 to 3 years ago. And then, now they're shocked. Well, what's going on? It's crazy. All right. Last article here, talking about the same subject, comes from Peter Schiff. It's titled Schiff and Then Something Broke. So let's go ahead and read through my notes here. The collapse of Silicon Valley Bank and Signature Bank has made it clear that the Federal Reserve is bluffing and will eventually fold. According to a recent article, the Fed quickly stepped in with the Treasury and FDIC to prevent systemic risk from spreading and established a new bank term funding program to allow banks to borrow billions to prevent further contagion. However, the article suggests that the collapse of SVB Bank was inevitable due to the risks of investing in long-dated U.S. Treasuries without hedging their interest rate exposure. This mistake was made by SVB, highlights the danger of neglecting risk management, as it could cause the collapse of even the fastest and safest securities. The article goes on to question how regulators missed this warning when its analysts had predicted this for months. The Fed's solution to this issue was to provide a program for a specific problem. However, the article argues that the next domino will likely be another issue and another emergency measure may be necessary. Additionally, the recent increase in the FDIC's insurance from $250 to infinity has raised concerns about moral hazard. Furthermore, the Fed guarantees all U.S. debts at 100% par value has implications for the market, as it could result in the printing of large amounts of money if the market decides to test the Fed. The article concludes that the Fed's recent actions amount to another Band-Aid, and the Fed has officially pivoted, as has been obvious for months. While the Fed may hike rates in 10 days, it is argued that it would only be to save face. The market currently sees a 25% chance of no hike next week and predicts that the Fed has only 50 basis points left in the entire rate hiking cycle. So right now we're at 4 3/4. So that would take us only up to 5 1/4 as far as the terminal rate, and inflation is still way above that. So I don't know. I mean, Peter Schiff seems to think that the Fed is already, pivoted, which, you might hear the term the Fed pivot or the Powell pivot, which essentially means that they're going to go from, the rates going up, they're then going to go back down, which is going to help big business, and then start buying up toxic assets, which is the quantitative easing portion of the stimulus. So again, I hope that doesn't occur, but I don't have a lot of faith in the retards who run the system. They're some of the dumbest humans I've ever met. Well, or I've never met them, but people I've seen speak, and I have to either assume they're lying because these people have to be too smart to have these jobs. So they either have to be lying when they say everything's fine. Oh, that's what I was going to say earlier. These same people who said everything's fine all through COVID, or the inflation stuff, the inflation is transitory. Janet Yellen was saying that a year ago at this time. Inflation is transitory. Or, well, that may have been May of 21. I forget. Yeah, the months just get blurry after a while. But, they said, oh, it's not this, no problem at all. And then what happened? Inflation went through the roof. Same thing with COVID. Oh, you got to go get your shots because you're all going to die. And then, come to find out, according to Dave Rubin, the number he quotes a lot is 1 in 800. One out of 800 people who got the jab had a bad reaction. So I don't want those sort of odds. I got better odds of surviving it at my age, and I'm 49 and I'm in decent shape. So anyways, all right. So I guess the point of that is don't believe these idiots. They will lie to your face and then the next day turn right around and then, do the opposite. So, all right. Well, that's everything I had to talk about for today. This was a soapbox session. I should, maybe patent that or something, or maybe I should stand on something, make me a little taller than the 5'9". I currently am. So, hope everyone has a wonderful evening. Like I said, the the NCAA tournament starts tonight. The play-in games, they're usually played in Dayton, Ohio. They should be on. And so have a great evening. I'm going to go watch some basketball and do some more chores around the house, play with my doggy back here. We're probably going to go outside and let him run up and down the hill for a bit and knock some of that energy out of him. And that'll be it. So hope everyone has a good night. I'll talk to you next time. Adios.